Thought leadership from PwC's National Office.
Welcome to PwC's Accounting Podcast. I'm Heather Horn. In today's episode, we discuss preferred shares as we continue our May miniseries focused on accounting topics from our very popular Financing Transactions Guide. Preferred stock's a common way for companies to raise capital, especially in today's interest rate environment. But did you know that not all preferred stock is accounted for as equity? Our guests walk us through this and many other judgments in accounting for different types of preferred stock. Even if you think you understand this topic, they will definitely have something to teach you.
So for those who aren't familiar with preferred stock, it's just a class of ownership in a reporting entity that's senior to common stock, but subordinate to debt. So it's in the middle there. And the terms of preferred stock can really vary greatly depending on the demands of the investor and what the company is looking for. So I think that diversity is why the accounting can be complex and probably why we're here today.
That was Brett Dooley, Deputy Chief Accountant in PwC's National Office, who leads our financial instruments team. Brett's joined by Chris Trudeau, also partner in the National Office, who has a lot of hands-on experience in this area. Brett and Chris bring their wealth of knowledge and experience to the conversation, so let's get started. Brett, Chris, welcome to the podcast. So nice to have you on. And today's topic is a great one, talking about preferred stock. This whole month is all about financial instruments, and this whole year is all about our most popular guides. And so this is focusing on one of our most popular guides, and preferred stock is actually one of the most popular sections of this guide. So obviously getting lots of questions. And I know particularly in today's interest rate environment, it's a way a lot of companies are raising capital. So Brett, maybe just taking a step back, I think preferred stock is a term people know, but actually knowing what it is, it sometimes is a little different. So can you just remind us of what it is and then why companies may be using it?
Yeah, I love this topic because I think you're right. It does apply to a broad sector of our clients and companies, and it's an interesting one. So for those who aren't familiar with preferred stock, it's just a class of ownership in a reporting entity that's senior to common stock, but subordinate to debt. So it's in the middle there. And the terms of preferred stock can really vary greatly depending on the demands of the investor and what the company is looking for. So I think that diversity is why the accounting can be complex and probably why we're here today. But I think companies choose to issue preferred stock for a really wide variety of reasons. Public companies may use it because they don't want to increase the level of outstanding debt. They're focused on their leverage ratios, or just to diversify their funding and access different sources. And typically the terms of that preferred stock that we see issued by public companies are probably more standard and have less bells and whistles to them.
Yeah, lots of utilities like to use preferred stock. So
yeah,
at least historically.
Sure. When you go into private companies, particularly in startups and early growth stage companies, we see them issue preferred stock as really just an alternative form of financing and a way to drive down the interest rate by including features in it, like conversion options that may allow investors to participate in the equity upside of the company while still giving them some downside protection in the form of redemption features or liquidation preferences. Typically, we see the preferred stock that's issued by private companies has a lot more features associated with that instrument. And so that's where we see more of the accounting complications.
All right. Not surprising, I guess, from that point of view. So then, Chris, bringing you into the conversation, what are some of these features that we're seeing then in these preferred instruments?
Yeah, like Brett said, the features can vary greatly depending on the needs of both the issuing company as well as the investor and what they're looking to get out of it and the protections that they're looking for. There's probably a few common features that you would see across all the preferred stocks. One usually you start with is liquidation preference. And that usually comes into play more, kind of like exit strategies, if you will, with companies. What happens maybe if a private company is going public or there's a takeover or something like that. And the liquidation preference, it basically, as Brett said, it's kind of senior to common stock but junior to debt, and it kind of gives like a way of kind of taking the funds that would get collected upon either liquidation or whatever, and kind of putting it right in there as to what they would get. And like I said, a little bit of protection over a common shareholder, but not quite as much as a debt holder.
Well, and it seems like if I'm putting these two pieces together, then you basically have to have this liquidation preference. It's like a sort of feature of all preferred stock, or no, are we going to get into some other features that could make something preferred over? If I just think back to the broad definition you gave, that it's sort of in between debt and equity from a liquidation preference, then it seems like you would need this. But
yeah, I can't think of many preferred stocks we see in practice that don't have a liquidation preference, because it's often critical to the investor demands. But you could have a preference, just a dividend preference,
it's
or
right.
some others. But I just think the liquidation preference is probably very common.
Very common. All right. So, Chris, what are some of these other ones? Brett stole some of your thunder with the dividend preference. But can you explain that one?
That's right. I mean, the next thing I was going to mention is dividends. Dividends are common in preferred stock investments. There's many different ways that the dividends can be done. There's usually some kind of minimum or guaranteed preferred, almost like an interest rate to a debt holder. It's usually going to be stated as some kind of fixed percentage or something like that. So it behaves similar to like an interest rate, and that kind of gives a little bit more of like the protection, if you will, that Brett was mentioning before. They don't necessarily get paid every period. There's a concept of cumulative versus non-cumulative dividends. Cumulative is more along the lines of that it's kind of like accruing like an interest, and whether they get declared and paid or not, they will kind of accrue and perhaps increase liquidation preference that we were just talking about. So it kind of gets paid on the back end, or whatever the takeout is, if it's a conversion or something like that. Non-cumulative would mean if I don't declare it, don't pay it in the period, it just is kind of like came and went. It doesn't accrue to anything, and it becomes a non-event, if you will. And then there could be additional dividend features. Some get more into a participation with the common equity, and so there's like a participation right. So if there's discretionary dividends declared on the common stock, the preferred stock would also get a similar dividend rate that could be based on the amount of preferred stock, or if there's a conversion on an if converted basis, which is how much common stock would they have had if they converted today, they get that amount of dividends. So various different ways that they can get their dividends. And
I guess maybe I should have started with this. We're starting from the point of view, you've already run through your liabilities versus equity model and concluded these are not liabilities.
Correct.
Okay. All right. I think that's an important point you have to take one step back before you even get to this point. But now that I've said it's not a liability, then I start with these considerations. All right. So then from that point of view, Brett, what is the accounting model? Once I've said, okay, I do have one of these preferred instruments, then how would I think about the accounting?
Before we go there, let's go through another couple features I think that are common in these, because some of the accounting that we're going to talk about is dependent on those features. So, one of those, maybe Chris, you want to talk for a minute about conversion options that we see a lot in these preferred shares.
Yeah, we were just mentioning a bit about the conversion options. So basically what it is the preferred shareholder may have the option. Sometimes it could be mandatory. Sometimes the issuer could have the option, but the preferred stock would convert into common stock. I think probably one of the more common conversion features we see is upon an IPO, like for a private issuance. Today, upon an IPO, it may automatically convert into the common stock being issued in the IPO. But there are also various options that can be done along the way. Similar, that's probably more like on an equity side of the preferred stock. Getting kind of back towards more the protection side, there could be puts or calls. So effectively, it's a way of cashing out early. The investor has the right to put the preferred stock back to the company for usually some kind of cash, payment. That kind of is more aligned with more like the debt side of where we are between the middle ground between the two. And then there could also be other protection provisions like veto rights or voting rights that just kind of helps the investor kind of have a stake or a say in what's going on in the company.
All right. That's definitely helpful and a lot to look for, because I think that does lead then into the next question that I jumped ahead on in terms of what we think about from an accounting perspective.
Yeah, and I think the accounting starts where you went earlier and think about a classification on the balance sheet. First of all, you have to determine whether the preferred stock is required to be accounted for as a liability. Some of these features, could call that into question. There's an accounting standard, ASC 480, that deals with that, and in some cases, something that is legally in the form of a preferred stock needs to be accounted for as a liability. If you determine it's not a liability within the scope of 480, then you have to think about where to put it in equity. And companies that follow SEC presentation rules need to consider whether the preferred stock needs to be classified as something we call mezzanine equity.
Yes, so I'm going to be talking to Chip Curry later in this series about mezzanine equity, so we don't have to go deep into that. But once we go through then that classification question, then thinking about measurement, what are some of the things we should be thinking about?
Right. So we talked about a variety of potentially complicated features, and we need to think about bifurcation of those features. We financial instruments folk talk about bifurcation like that's a normal word, but it's essentially looking at an instrument and determining whether there's some feature that needs to be separated from what we call a host contract and accounted for separately as a derivative instrument. And so the next step in the preferred stock analysis is assessing what is the nature of the host contract itself and whether that preferred stock is economically more akin to a debt instrument or an equity instrument. And when Chris was going through features, he said this could be more debt-like, more protective versus more equity-like. It's important to note that I think that assessment is focused on the economics of the instrument, and it's different than the classification assessment. So it's possible for a preferred stock that I determined to be in the equity or mezzanine classified, but it could still have a debt host for this measurement purpose. So, and we can go through that maybe in a little more detail, but just remember it's not an accounting classification. You're looking at the economics of the instrument when you're doing that host contract evaluation. And so once you determine the nature of the host contract, then you assess whether those embedded features that we're talking about require bifurcation and need to be marked to market, as derivative instruments separately. This is all a complicated assessment, right? So companies issuing for the first time, like, where do I start? And I think it's important to start with the right documents in front of you. So if you're doing one of these analysis, start with the preferred stock agreement. It's called the stock purchase agreement sometimes. But if the company is private, it's often helpful to have their formation agreements too. Think of like an LLC or an LP agreement. Importantly, it's also important to ask for any side letters that the company has entered into with investors. Sometimes some of these features we talk about are documented in the preferred shares themselves, but they're documented in a side letter with a particular investor. So actually different investors could have different side letters and that need to be evaluated separately. So it's important to look at all the documents that are going to have any of these important terms or agreements in them.
I might add, Brett, that a lot of preferred stock are issued to employees or things like that, right? So employment agreements could be another document that you need to think about as far as potentially having terms.
Great point.
Yeah, so it definitely makes sense. You have to sort of look for all these agreements. And I also think it's almost a reminder of the complication of this area, the fact that you've concluded it's not debt, and yet, Brett, to your point, it could be a debt host. And I think that's where this starts to get confusing to them to kind of, as you walk through. And so it is important, make sure you have all the agreements, but then also make sure you sort of follow the accounting models in the right order and just take a step by step, because otherwise you're just going to confuse yourself, basically.
Our guide in this area has a lot of flowcharts.
Yes.
Like think about.
I was thinking about those flowcharts.
Just like we did. Like think about liability first, and then think about your equity or mezzanine, and then once you're through there, think about measurement, and you're going to think about host contract, and then you're going to think about bifurcated features. So it definitely does help to follow those kind of flowcharts.
So as we're thinking about those flowcharts then and kind of walking things through, what is, Chris, I'll go back to you, sort of this first step of determining the classification.
Yeah, so you mentioned it before, Heather. The first step is thinking about if it's actually recorded as a liability, and specifically under the accounting codification guidance, it's in section ASC 480, and it gives 2 or 3 different types of instruments that are in between equity and debt. Not issued in the form of debt, but issued in the form of equity, or a contract that is issued in the form of equity. And it says if it kind of meets these criteria, it gets recorded as a liability. When you're talking about preferred stock itself, like actual shares of preferred stock, there's usually 2 basic areas within that guidance that it could fall under. One is mandatorily redeemable, and it's a bit of a mouthful. But basically it means if it is kind of certain that there is a redemption that's going to occur. So one example could be preferred stock that will be redeemed for cash or other assets in 5 years. It sounds more like a debt instrument because it probably is closer to a debt instrument than the equity. And so the FASB has said that's a liability, record that as a liability. Similar to that, also under this category of mandatorily redeemable, could be an event certain redemption. So preferred stock perhaps issued to a key employee that gets redeemed upon termination of that person's employment, or sometimes, as morbid as it may sound, death of that person, would require a redemption. Like that, unfortunately, is an event certain to occur, right? At some point, someone will leave a company. At some point.
So the fact then, in this case, you don't know when it occurs does not impact the accounting.
Well, it may impact the measurement of it, but it doesn't impact the classification.
All right. This is an important point then to point out. All right.
Right.
So
there's a second kind of feature or instrument that will, if you will, under this guidance, and that is preferred stock that could be settled in a variable number of shares, common shares, right? So, think about similar to what we just said, where a preferred stock is mandatorily convertible in 5 years, but it's based on a fixed dollar amount. So it's $1 million divided by the price of the common stock on the day of mandatory conversion, and so you get a variable number of shares. What the guidance says, if it's based predominantly upon a fixed dollar amount, then it is similar to being redeemed, like for cash or some other asset.
Oh, so the fact that it is redeemed in stock is not the important, or equity is not the important point, because the value of what you're getting is the key point there.
Exactly. So it's kind of similar to, if you may be familiar with stock settled debt, right? And it's kind of the same concept, is you're getting a fixed amount. Just the fact that it's being paid in variable shares doesn't matter. Doesn't make it equity at that point in time, because it's like settling a liability for a variable number of shares.
So then if we conclude that this preferred stock is a liability within the scope of 480, then what is the initial measurement?
So the initial measurement, I think in any case really, with the preferred stock issuance, the initial measurement would be the fair value, which is usually going to be the proceeds paid by the investor, but there could be times when it's like in a multiple transaction or something like that, you kind of have to allocate, but it should be recorded at fair value.
All right, that's helpful. And then let's assume, so now I'm going down my flow chart, I can visualize it, and I've concluded, okay, this is not liability. So then I think I know the answer here, but then does it just get recorded in equity?
I'm going to give you a definite maybe on that one.
All right, I feel like that's the accountant's favorite answer.
So you and Brett were talking a little bit about the mezzanine classification, right? So there's kind of this subset, if you will, between actual liabilities and actual equity. We call that permanent equity. That is this mezzanine equity. And it's things that aren't quite a liability, but there is some kind of called contingent redemption or optionality behind the redemption. So it's not mandatory, right? So it's not, clear cut that it's a liability, but there are potentials for this to get redeemed. And so that would generally wind up in this mezzanine classification. But I don't want to go too deep into it, because I know you mentioned you have another. Yes,
I'm going to talk to Chip about that. Although it is interesting when you describe it that way. It's almost like you can't quite make up your mind. So let's just go to the middle in between those two. But anyway, so keep going though, if at least to give a quick preview so we can keep going with our discussion today if you do wind up in this mezzanine.
Yeah. So, I mean, similarly, when you initially measure it, it would be at fair value. And then depending upon whether it's actually redeemable or it's probable to become redeemable, there may be subsequent measurement to kind of remeasure at either the redemption amount or what the redemption amount, could be in the future. Like sometimes it's redeemable in 5 years. You might accrete to that number over the 5 years. Sometimes it's redeemable today. Sometimes it's contingently redeemable, and you're not sure if that's going to happen. And so if you think it's probable it will, you may start, accreting or recording to that redemption value today. But if not, you may do nothing at this point and kind of wait and see if it does become probable of being redeemable.
So you mentioned, though, that this guidance for mezzanine is SEC guidance. So do we see private companies following that too, or what's our view then for private companies?
Yeah, so I mean, I would say definitely if you're a private company but you have intentions to go public, you should probably be following that guidance now, because at the time that you would go public, you would have to, right? And sometimes it gets harder to kind of have to go back and redo the accounting under this model, right? So definitely if you're planning on going public, start following the model. Absent that, I think we would say it's generally a good idea to follow this, especially if that equity is not, very clear that it will be permanent, for the company, right? So it makes a lot of sense to follow that, and we would definitely encourage private companies to follow that guidance.
Yeah, it always seems like if there is a model, then it's better to follow the model than just to make up your own accounting. So with that said, then let's presume I keep going down my flow chart and I've said it's not an ASC 480 liability and we don't have to present it as mezzanine. Then it becomes part of this, quote, permanent equity.
Well, eventually you were going to run out of other places to put it, right? So eventually it's going to wind up in permanent equity.
Okay, fair enough. It's not an asset. So.
It's not an asset, correct.
All right. So then we talked about this more basic model the model for the more basic preferred. But Brett, going back to you and the discussion of bifurcation, which I feel like is a word any non-derivative expert does not like to hear. But let's assume you have to consider this potential bifurcation, assessment of the host contract, et cetera. Where would you start with that?
Yeah. So as I said before, the assessment is not based on the legal form. So don't start with that. It's just a different analysis than both legal form and the accounting classification. And to level set what a host contract is think about it as the instrument that would have been issued were it not for these embedded components. So it's the hybrid instrument that was issued without these embedded components. And there's a little bit of a chicken or the egg in figuring out what's an embedded component versus what's a host instrument. Maybe this is a little more clear with some examples. And I think sometimes the nature of the host contract is actually pretty straightforward. For example, you can have a hybrid instrument that's legally a debt instrument that's going to have a debt host. But where we run into complications is where it's an equity instrument like we have in preferred shares, where the host assessment requires a lot of judgment. You need to think about all the substantive terms and the implied terms in considering it. You're going to look at things like redemption features, conversion options, dividend rights, voting rights, all the things that Chris talked about, collateral requirements, liquidation preference, and creditor rights, just to name a few. But you're trying to figure out what the nature of the core instrument is. And it's not a check the box exercise. Like I just listed a bunch of factors and you could see people, well, I'm going to make the list and I've got 3 check marks over here and I got 2 check marks over here. I think it's a little more complicated than just looking at the existence of those features. And you'll have to weigh them. So part of the weighting exercises is thinking about the most likely economic outcome or the most likely economic or exit scenario for the company. So for example, think of you have a preferred stock that has a contingent redemption feature tied to the occurrence of a deemed liquidation, but it also has a conversion option tied to an IPO. When the company's weighing the impact of that, they're going to assess the likelihood of an IPO versus the occurrence of a deemed liquidation. If they think the IPO is highly likely, they're going to look at those equity features as the core host.
So, Brett, one question before we go on. In the example you just gave, your assessment of the likelihood of the IPO is changing over time. But for this particular determination of what is the host, you are not reassessing that after you first enter into the contract.
That's right. You assess it at issuance, and then your weighting may, like you said, evolve over time. You may be proved to be right or wrong. It's a one-time assessment.
So, Brett, I think that's really helpful because this can be very judgmental, and trying to figure out then exactly what is the host can be more complicated depending on the number of features that you have.
I think that's right. It's an area where if this is your first time assessing it, you probably want some help with some experienced folks. I think we probably get more consults on this host identification than we do on classification, just because of, as we walk through, how judgmental it can be.
Yeah, well, I think I said earlier, this is a very popular section of the guide, but then sometimes having a person to talk to can be quite helpful. So definitely encourage.
Maybe to give a little perspective, right? I think when we talk about it within a spectrum of all the instruments. There's probably 10% of the instruments are all the way on one side, which is very clear equity. 10% of the instruments are all the way on the other side, which is very clear debt. And then 80% are in this gray maybe zone.
Yeah, that's actually very helpful perspective, and why it might be helpful to ask questions of people like you and Fred. So if we kind of navigate through all of this and we have figured out then, do we have a debt host or an equity host? Then, Chris, how does that impact the rest of the accounting? So we're going to bypass all that complicated and just now we have an answer. Debt, equity, what do we do next?
Well, gee, when you're getting to bifurcating embedded derivatives, I'm not sure that's the simple part of anything, right? But yeah, so I mean, with all these different features that, we've been talking about, right, these, are potential features that if you look at the derivative guidance, the guidance would tell you if there are things embedded within a contract that are otherwise a derivative, you may have to separate that from the contract, right? And there's maybe 2 or 3 criteria for doing that. Does this feature actually meet the definition of a derivative? If it does, is there a related scope exception for that? And oftentimes when we talk about scope exceptions within, equity like preferred stock, it's usually going to be, own equity scope exception, which is 815-40. But that's a whole other, episode, I'm sure, in and of itself. So I don't really want to get into that. But that's usually going to be an important thing to understand as well when you're talking about like the conversion options and such. But, so if you do have a derivative and it does not meet a scope exception, the third criteria is whether it's clearly and closely related to the host contract. Because if it is clearly and closely related, it doesn't matter. You don't have to bifurcate it. But if it's not, and like I said, it meets the definition of a derivative, then you would have to bifurcate it. And so that's why it's very important to understand, what do I have economically as my host contract? Is it debt or is it equity? Because sometimes these definitions and the scope exceptions that we were just talking about can get very complicated. So if you can kind of get to whether or not it's clearly and closely related first, you may be able to kind of bypass all that, because if you can say it is clearly and closely related, it doesn't matter if it's a derivative or not.
Yeah, although sometimes clearly and closely related is not the easiest
well,
either.
Well, that goes back to your complexities around the host contract.
Exactly.
But, yeah.
So with all of that said then, I think we keep saying it's complicated, but so maybe we can go through an example that hopefully at least will illustrate some of this.
Yeah, sure. So let's say that you conclude that the preferred stock host contract is an equity host, right? So you look at the equity host, and you have perhaps one of these put features that we were talking about. So the investor has the ability to put the preferred stock back to the company for cash or other assets, and so that may sound very much like a maturity, like a debt, right? So that is a debt-like economic feature within an equity host contract. And so if that put would meet the definition of a derivative, then you would say that's not clearly and closely related to an equity host, and you'd have to bifurcate it. On the other hand, if you had concluded that host preferred stock was more akin to a debt host, then it could be clear and closely related. I mean, there are some specific guidance around how to measure clearly and closely related when it comes to, puts, especially if there are significant premiums or discounts, or, the put feature is kind of leveraged up in a way that may not necessarily be clear and closely related. But I would say for the vast majority of, puts for these, they probably are clearly and closely related. On the other hand, we talked about conversion options, and kind of the flip-flop occurs, right? So if I have an equity host preferred stock and I have a conversion right, that's truly an equity conversion, right? We would say that that's clearly closely related. So even if it meets the definition of a derivative, you wouldn't have to bifurcate. However, conversion, is equity-like features. So if you had a debt host on the preferred stock, then, and it doesn't, meet the scope exception that we mentioned before, you would have to bifurcate at that point.
All right. So definitely goes back to understanding not just the agreements, but the economics of these contracts to really understand how these pieces will fit. And I think then the other key point here is that if you do conclude it is a derivative, or that it would meet the definition of a derivative, then it would need to be bifurcated and measured at fair value. Yeah.
So at that point, it would be like any other derivative. So it gets marked to market through P&L and gets fair valued.
And then I guess one thing just to make sure, so then what's left, what do you do with the host that's left? So you bifurcate, you take out the derivative portion, so then what happens to the host portion?
Well, that goes back to kind of depending. So, if it was kind of impermanent equity, otherwise there's nothing really that you do with the host after the initial recording. If it's in this mezzanine that
then you follow the model. So it's kind of have to go back around basically once you reach this conclusion to figure out the accounting for that. All right, that's helpful. So then we talked about the accounting for the instrument itself, but I know dividends are often a feature of these preferreds. So then, Brett, coming back to you, how should we be thinking about these dividends in the accounting, especially because Chris, I believe, had mentioned earlier, we can see also these two different types of dividends.
Yeah, I think the key here is dividends on preferred stock come in a variety of flavors, and that's going to change your accounting slightly. You can have a stated or a fixed rate on them. They can be cumulative or non-cumulative. You could have rights to these discretionary dividends or participate in dividends alongside common stockholders. So the accounting treatment for them is going to depend on what we're talking about. In general, periodic dividends are recorded when they're declared by the board of directors because the declaration by the board creates a liability for the company. In some cases, we see that the agreement, the preferred share agreement itself, legally obligates the company to pay dividends, even without a formal board declaration. If that's the case, then the dividends should be accrued whenever they're earned under the contract. In some cases, these dividends are cumulative. Chris talked about this, where even if a cash dividend isn't paid in a certain period, it accrues to the holder over time and is paid at some future date, maybe upon liquidation or redemption. And here, I think there's a couple things to think about. First, that cumulative dividend could impact the liquidation preference or the redemption value of preferred shares. So when you're thinking about mezzanine classified instruments that may be recorded at their redemption value, it could affect that redemption value. So keep in mind if you've got mezzanine classified preferred stock with that cumulative feature. The other reminder is that even though if you've got a cumulative feature, if the board didn't declare a dividend, in most cases, EPS computations should still reflect accrued but undeclared dividends on these cumulative preferred shares. So jump ahead to all of the EPS podcasts that we talked about. The other thing I'd mention is when preferred shares participate with common, Chris mentioned this earlier, you may need to apply the two-class method of computing basic EPS. And so I won't get into those details there, but I think it's an important consideration to make when you're talking about these preferred dividends is not just to think about your balance sheet income statement, but what it's going to mean to EPS.
All right. So definitely, again, a lot of pieces to think about. And we will include links to those other EPS podcasts in the show notes because that is a whole other topic. So that then would take me to our last topic, which is, all right, we're talking about day one accounting, subsequent accounting, but now talking about extinguishment or modification accounting. What are some of the things then, Chris, we would think about when we're dealing with preferred stock?
Yeah. So, what's interesting is that, preferred stock in of itself sometimes could have very well-defined cash flows, as we've been talking about. Mm-hmm. Maybe that's more like the debt type features we've been talking about. Or it may not involve very detailed or defined cash flows. So it makes the analysis of modification versus extinguishment a little bit complex. Maybe that's the theme for today, right? There's a lot of things that seem simple but are very complex, right? and you could have changes in the terms that could have a significant impact on the fair value of the preferred stock, but again, doesn't really impact the defined cash flows per se. It could be modifying or introducing a conversion option that wasn't there before. It could be, changes in the liquidation preference amounts and things like that, right? So, again, it could have an impact on the fair value, but really not on the cash flows. And unfortunately, there really is no defined model or guidance within codification on how to think about modifications versus extinguishments for preferred stock. There is an SEC speech that people generally look to, but that's not codified within the guidance. So as far as like what the model, could be, or what the SEC speech kind of laid out what a model should be, there's probably like 2 or 3 different ways of going about thinking about it. Generally speaking, you start off with like a qualitative or a quantitative assessment, and qualitative could be, well, gee, the changes are just so clearly inconsequential that clearly is not extinguishing the old instrument. It's just simply a minor modification. That's just usually going to be more things like administrative type changes to the document. On the other hand, there could be changes that are so clearly significant, like I just said, maybe introducing a significant or substantial conversion option that wasn't there before. Like that clearly, is something that is a very big change to what I had. So that would say it's really not kind of the continuation of what I had. It's really a new instrument that's being issued. And so that would say I should extinguish the old and put on this new instrument. But not everything's going to be that black and white, right? It's not going to be that clear cut that it's very inconsequential or that it's very significant. And so the next step is, if I can't really qualitatively say it's clearly one or the other, I have to have some sort of a quantitative analysis. One approach could be very similar to the debt model, which is, kind of look at the change in the cash flows, and if there's a 10% or greater change in the present value, then I would call that an extinguishment. If it's less than 10%, I would call that a modification. So if I have these preferred instruments that kind of behave a lot more like debt, has a fixed stated interest rate, perhaps not a mandatory redemption date, because that would be a liability, as we talked about before, but something similar to that, where it's going to kind of clearly be put, there may not be a conversion in there. So you can really see the ultimate takeout is likely going to be some kind of put. You can kind of use that and kind of define the cash flows and do a model very similar to the debt. On the other hand, instruments that don't have that kind of very well-defined set of cash flows, you may look at the change on a fair value basis. So a little bit similar to the guidance that's in stock compensation, right? And so you look at, what was the fair value before the change? What was the fair value after the change? What's that difference in the fair value? And measure that as a percentage of the original contract or the fair value. So a 10% or greater change based on the change in fair value would lead you to say, I kind of have a new instrument, and so therefore I've extinguished the old. And something less than 10% would say that's more of just a continuation. It's a modification because the changes were minor.
So then you mentioned that this guidance is not codified, but in practice, is it pretty well accepted? These are the approaches that people would take in dealing with these types of changes?
Yeah, I mean, partly I think it makes a lot of sense.
Well,
right?
me too. That's why I was curious. I mean, it seems very logical when you laid it out that way. So,
I mean, one thing I should mention is, it's not really a legal instrument assessment. I think maybe years ago, some folks would think, if I kind of legally extinguished or legally simply modified, I would follow that. But I think that's kind of no longer the in vogue way of thinking of it.
In vogue, all right. I never knew we'd be using that terminology talking about accounting, but impressive.
And obviously, like Chris laid out a pretty clear framework.
Yes.
Right. Oh, if it has cash flow, defined cash flows, use this model. Like applying that in practice can be difficult because obviously, as we've talked about, everything here is not all one thing or another. Right.
But it is helpful, though, at least to have sort of this framework that does seem very logical.
Yep.
So assuming you make it, again, through another judgment, which now I should have been keeping track how many we've talked about today, then what is the accounting, depending if it's extinguishment or modification? Yeah,
so maybe we'll start with extinguishment. That maybe is a little clearer, right? Yeah. So I kind of, in an extinguishment model, I am de-recognizing the old instrument, and I'm recognizing the new instrument or whatever consideration was given in the extinguishment. So sometimes it could be cash, it could be other assets, or it's usually just simply a new preferred stock instrument. I would measure a gain or loss. No, not a P&L gain and loss yet. So I'll use that term a little loosely, but I measure a gain and loss as the difference between the consideration being paid, so the fair value of the new instrument, and or cash or whatever is being given up, as the difference between that and what the carrying value of the old instrument was. That gain or loss doesn't really go through the income statement, but what that does is get recorded as like a deemed dividend in retained earnings.
All right. And then how about if it's modification?
So it's a modification. It's a bit trickier, right? Because you're not really taking the old off. And really what you need to do is think about, did I transfer any value? And usually, when we talk about that, it's a transfer between the common equity holders and the preferred holders. And if it's determined that there is a transfer of value between the two, it would be a similar model that we just talked about. It would be recorded as a deemed dividend within retained earnings. But if it's determined that there really was no transfer of value, or maybe there was just simply, transfer amongst preferred shareholders, then you may not record that deemed dividend.
All right. So definitely a lot to think about. And I do think we use the word judgment. I should have been keeping a tally, but I feel like each step of this is complicated enough to practically be its own podcast. So taking a big step back, maybe just wrap things up. I know you guys deal with a lot of questions on this topic. Obviously are also helping write PwC's interpretive guidance and otherwise. And so what advice would you give to someone who's kind of encountering one of these, maybe for the first time, or even if they have dealt with it before, it's not like a weekly occurrence. So Chris, maybe I'll start with you on that.
Well, I think Brett said it when we started, really, is making sure you fully understand everything that you're dealing with, right? That you've thoroughly looked at the contracts, whether that's the actual stock agreement itself, whether it's, other side letters or other types of agreements that provide the terms, because the starting point really is making sure I understand everything that I have, because it could be very easy to overlook something.
All right. That's great advice. Brett?
Yeah, I'd say keep organized and work through that flow chart. It's easy to jump ahead,
that was what I was worrying about. Yes.
To one thing. I think Chris's point around making sure you know what all your agreements are is important, because where we see, especially when you get into that bifurcation analysis, some of those things that can be bifurcatable derivatives are fairly nuanced in the agreement. So you really have to kind of know what you're looking for and read these agreements and step through this whole analysis very methodically.
I might also add that our financing guide has a chapter dedicated to preferred stock. I believe it's chapter 7 in our financing guide. And so we go through a lot of what we just talked about, maybe even a little bit more detail with some questions and answers on some other features as well. Less common, so that that may be another place to, if you really want to do some reading, you could check out our guide in chapter 7.
Excellent advice, and definitely a pleasure to talk to both of you today. Thanks so much for joining me.
Thank you.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.